Quarterly earnings and advanced guidance on those earnings, the forecast, have become the measuring stick for how well a company and its management team is doing. But some say all that quarterly guidance is actually hurting companies because it causes CEOs to shift their focus on the short term and stock prices instead of long-term business performance. Matthew Orsagh joins us now with his take. He's an analyst with the CFA Center for Financial Market Integrity. Welcome to the program. Thank you for joining us. When did it happen that a penny per share became either the basis for some kind of a, glorious accomplishment for a company or deep disappointment all in one day, all based on a penny?
Well, it's something that evolved over time. This is a practice we didn't really have 15 or 20 years ago. But analysts and asset managers in the street started realizing that if companies missed by a penny or exceeded their expectations, that was a way to make money. And over the years, they decided to ask management more and more guidance, and management provided that guidance, and we've generally eventually evolved to the stage we're at now, where it's become expected. And we think it focuses too much attention, as you said, on making those pennies and not on making sure you're investing for the long term.
Isn't a real problem here, Matthew, the Wall Street analysts? I mean, you look at Warren Buffett and his company, he does not communicate with these people. When he has quarterly numbers, he puts out something on his website that says the numbers will be posted on September 20th or whatever date, and boom, they're there. That's it. Anytime a management of a company is communicating with an analyst and telling that analyst something he or she is not telling shareholders, that's selective disclosure, and it's illegal. I mean, these people it's outrageous, some of the stuff they expect from companies, isn't it?
Oh, exactly. You're not going to go poor following what Warren Buffett does. One of the things we found when researching this project was a paper that came out early last year done by Duke University and Washington University, and it was really eye-opening. It interviewed over 400 executives and found that over 80% of them said they would forego kind of long-term planning, seed planning kind of activities such as R&D or marketing or other long-term investments if it meant that they would miss short-term numbers. And over 50% also said that they would not invest in net present value positive projects that would be long-term value creators if it meant missing quarterly earnings guidance. And that's when we knew we really had a problem on our hands.
Okay. What happens if this stuff goes away? What if we woke up tomorrow and there was no quarterly guidance? You still come out with the earnings every 3 months, just like we always, but there's no more guidance. You just wait for the earnings. And what are the repercussions from that?
Well, I don't know if that would be so bad. I mean, look at, again, Warren Buffett, some of the companies that have decided to stop giving earnings guidance. NERI, the National Investor Relations Institute, comes out with a paper every spring surveying their membership. And over the last couple of years, there's been a trend with companies giving less and less quarterly guidance. Some still give annual guidance, and more give annual guidance than quarterly guidance, and some have stopped giving guidance altogether. I think if this goes away, you'll have companies being able to focus more on the long term.
Is there really something wrong with a CEO or a CFO communicating about what's going on with the company's bottom line? We're not necessarily talking about what Andy just mentioned, which was just talking to an analyst, just in general. Is there something intrinsically wrong with that, or is it just that you're trying to look at the behavior of what happened in the late 90s and the boom time and Enron and trying to figure out a way to curb it, and this looks like a potential way to do it? But is there really something wrong with just talking about what's going on?
Well, I want to make a distinction between earnings guidance that is given and just earnings and quarterly reporting. One model that we found works well is one of the companies we talked to gives out monthly operating data, the same kind of data they use to run their business internally. And this is actually giving out more information than they do as far as quarterly earnings guidance. They give it every 30 days instead of every 90 days. But it's something they post on their website for everyone to see, and it tracks maybe the 6 or 7, 8 or 9 metrics that they use internally to measure their company, not just that one metric of earnings per share.
All right, Matthew, we're going to have to leave it there. It's interesting stuff. Perhaps changes ahead, perhaps not. Matthew Orsagh, the Senior Policy Analyst for the CFA Center for Financial Market Integrity.